Picture this, the stock market climbing to unprecedented peaks, fueled entirely by the dazzling promise of artificial intelligence. But here's the kicker. Fears are mounting that this explosive rise might just be the prelude to a massive bubble ready to burst. Is AI the golden ticket to endless prosperity, or are we witnessing the setup for another financial meltdown? Let's dive into the details and explore why this topic has investors buzzing and experts divided. Since 2022, when OpenAI unveiled ChatGPT and sparked a global frenzy, artificial intelligence has dominated the investment landscape. Enthusiasts have poured optimism into the idea of an AI revolution, channeling vast sums into technology shares. As a result, stock prices have skyrocketed to levels that many consider alarmingly high, reminiscent of past speculative frenzies. For beginners, think of a stock market bubble as a situation where excitement drives prices far beyond a company's actual worth, creating an unstable boom that often leads to a painful crash. Like the dot-com bubble in 2000, when internet hype inflated tech stocks before they plummeted, wiping out trillions in value. But here's where it gets controversial. Are these soaring valuations genuine signs of progress, or red flags waving in the wind? Analysts point to the massive investments by tech giants as evidence of potential overreach. Companies like Meta, Microsoft, and Amazon have shelled out hundreds of billions on data centers and AI infrastructure, with even more billions planned for the future. Their quarterly results have dazzled Wall Street, justifying those lofty stock prices and keeping the rally alive. Yet, skeptics worry if this momentum can last, and what chaos might ensue if stocks take a sharp tumble. Kristalina Georgieva, the head of the International Monetary Fund, captured this tension in a recent speech, noting how global equity prices are surging, ignited by hopes that AI's productivity boosts. She warned that current valuations echo the internet mania of 25 years ago, and a sudden market correction could tighten financial conditions worldwide, slowing global growth. It's a stark reminder that while AI promises efficiency gains, like automating tasks in factories or enhancing medical diagnostics, over-reliance on hype can distort reality. In recent weeks, the unease has intensified with eyebrow-raising deals, such as Nvidia and OpenAI's circular financing arrangements, where companies essentially fund each other in ways that some see as artificially inflating the market. Strategists at Goldman Sachs have drawn parallels to historical bubbles, stating that while we're not fully in one yet, the heavy concentration in AI investments calls for smarter diversification. They advise spreading bets beyond just tech to avoid getting caught in a downturn. Despite these worries, AI-related news continues to electrify the market. Just last week, OpenAI's partnership with chipmaker Advanced Micro Devices, AMD, sent AMD stock jumping nearly 24%, highlighting the insatiable appetite for anything AI-tinged. This surge invites comparisons to the dot-com era, but investors argue there's a crucial distinction. Today's big tech players are profitable powerhouses, not speculative startups. Eric Friedman from US Bank Asset Management puts it plainly. Unlike the 1990s, where unprofitable newcomers drove the frenzy, this rally is backed by solid earnings from mega-cap firms. Mike Mullaney of Boston Partners describes the current state as bubble light. Elevated risks from high valuations and concentrated investments, but not yet the full-blown euphoria that signals peak danger. Sentiment hasn't peaked yet, he says, so the market could keep climbing. And this is the part most people miss. While past bubbles burst amid irrational optimism, today's AI boom is grounded in real technological advancements, like machine learning algorithms that are already transforming industries from healthcare to transportation. AI's dominance is reshaping the broader market too. In the SP 500 index, which weights companies by their market value, tech stocks have become a colossal force. 7 giants: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla have driven 55% of the index's gains since late 2022, according to SP Dow Jones Indices' Howard Silverbat. For everyday folks, this means your 401k retirement savings might be riding high on these tech titans, sharing in their successes. But it also exposes you to significant risks if the market corrects sharply, potentially leading to prolonged losses that could delay your retirement dreams. The Bank of England echoed these concerns in its latest report, highlighting stretched valuations in AI-focused tech firms and the dangers of market concentration. If AI expectations falter, it could leave indices vulnerable to steep declines. This harks back to 1996, when Federal Reserve Chair Alan Greenspan questioned if irrational exuberance was gripping markets, though the dot-com peak didn't hit until 2000. Fast forward to today, and current Fed Chair Jerome Powell has called stocks fairly highly valued, sparking debates about history repeating itself. Ed Yardeni of Yardeni Research ponders aloud, are we heading back to the irrational exuberance of the 1999 tech bubble, followed by the wreck of the early 2000s? Maybe. Yet, he points out that this year's highs are fueled by unexpectedly strong earnings, with projections for the SP 500 reaching 7,700 by year's end. It's a balanced view that underscores the debate. Is AI a sustainable driver of growth, or just another fad poised to fade? What do you think? Is the AI hype justified, or are we ignoring warning signs that could lead to another market crash? Do you believe big tech's profitability makes this rally different from past bubbles? Or is concentration in a few stocks a recipe for disaster? Share your thoughts in the comments. Let's discuss whether AI is revolutionizing investing or setting us up for a fall.